Buenos Aires, December 2001. A school teacher named Elena pulls up to her bank on a Tuesday morning. She has $14,000 in her savings account, 12 years of careful deposits. She's not rich. She's disciplined. She did what every financial advisor, every government official, every newspaper column told her to do. She saved in dollars. She kept her money in a regulated institution. She trusted the system. The bank is closed. There's a handwritten sign on the door. It will stay closed for 11 days. When it reopens, a government decree called the Corralito will limit her to withdrawing 90 pesos per week. By the time those restrictions lift, the peso, which had been pegged 1-to-1 with the US dollar for a decade, will be worth 25 cents. Elena's $14,000 is now worth $3,500. She did everything right. That's the part nobody talks about. What happened to Elena wasn't a random disaster. It wasn't bad luck, and it wasn't a failure of personal discipline. It was the terminal phase of a specific monetary mechanism, one that had been running for a decade before the bill finally came due. Argentina's 2001 collapse wiped out the peso savings of an entire middle class in a matter of weeks. An IMF working paper from 2003 put the wealth destruction at roughly 67% of household savings in the banking system when measured in real dollar terms. Some economists put it higher, but here's what the case study almost never includes. Not everyone lost. A specific group of Argentines, not the richest, not the most connected, not the ones with offshore accounts, held assets that came through the collapse with their value largely intact. Not because they got lucky, because they understood something structural about what they owned. This video is an autopsy of what they held, why it worked, and whether the same mechanism is running somewhere near you right now. The setup. 10 years of a beautiful lie. To understand 2001, you have to go back to 1991. Argentina had just survived a period of hyperinflation that peaked at 3,000% annually in 1989, according to the IMF's historical data series. The peso was meaningless. People were pricing goods in dollars on the street. The government's response was the convertibility plan, a hard peg that locked one Argentine peso to one US dollar, backed by a legal requirement that the central bank hold dollar reserves equal to every peso in circulation. It worked. Inflation collapsed. Foreign investment flooded in. The Argentine middle class started saving in pesos again because pesos were, legally, dollars. For 10 years, this felt like stability. It wasn't. The mechanism. Borrowed credibility. The convertibility plan didn't create wealth. It borrowed credibility from the U.S. Federal Reserve and rented it to Argentina at a fixed exchange rate. The problem is that Argentina's economy and the U.S. economy don't move in sync. When the U.S. dollar strengthened in the late 1990s, which it did significantly, Argentine exports became more expensive to every buyer in the world who wasn't paying in dollars. Manufacturing contracted. Unemployment rose. The government's response was to borrow. Between 1994 and 2001, Argentina's public debt roughly doubled as a share of GDP from around 35% to over 60%, according to World Bank historical data. They were borrowing dollars to maintain a peg that made their own exports uncompetitive. The mechanism was simple. The timeline wasn't. Nobody who lived through it saw the end coming either. The break. Why the peg couldn't hold. By late 2001, the math had stopped working. Argentina needed dollars to service its debt. It was running out of the reserves required to maintain the peg. And as depositors began to sense the instability, quietly, then all at once, they started converting pesos to dollars and moving money offshore. The government's response to the capital flight was the Corralito, a freeze on bank withdrawals announced December 1st, 2001. You could no longer take your money out of the bank. The official justification was to prevent a bank run. It was already a bank run. They just made it illegal to complete. In January 2002, the peg broke. The government announced pacification, mandatory conversion of all dollar-denominated bank accounts into pesos at a rate of 1.4 pesos per dollar, while the market rate was already approaching 3 pesos and climbing. Savings accounts that were legally denominated in dollars were, overnight, redenominated into a currency losing value by the hour. That figure should terrify you. Because it happened legally, inside a regulated banking system with full government backing to people who had done nothing wrong. That's the historical record. Now here's why it matters today. The asset class that came through, the Argentines who didn't lose their savings in 2001 weren't primarily the wealthy with Swiss bank accounts, though some of those existed. The group that held up most consistently was people who owned one specific category of asset, real productive property that generated income in whatever currency the buyer had. Not peso cash, not peso savings accounts, not peso-denominated bonds. Physical real estate, particularly residential rental property in dollar-denominated markets, and agricultural land that produced commodities priced internationally. Small business owners who invoiced in dollars or traded goods with export value. And critically, people who held physical dollar cash outside the banking system entirely, which Argentines call el colchón, the mattress. The common thread is not a specific asset class. The common thread is institutional independence. Every asset that survived had one property. Its value was not contingent on the Argentine government's willingness or ability to honor a contract. A savings account is a contract with a bank, backstopped by a government. When the government changed the terms of that contract unilaterally, which it did legally in January 2002, the account holders had no recourse. A piece of land producing soybeans priced in international markets didn't require the Argentine government to honor anything. The mechanism, not the asset. This is the part that most collapse prep content gets wrong. The lesson from Argentina is not buy land or hold physical cash. The lesson is about the mechanism of institutional dependency and how to map it onto whatever financial instruments you currently hold. Every financial asset you own exists on a spectrum. At one end, assets whose value depends entirely on institutional promises, bank deposits, government bonds, pension entitlements, annuities. At the other end, assets whose value derives from something the institution cannot redenominate, productive real property, hard commodities, equity in businesses with real foreign revenue. The Argentine collapse didn't discriminate by wealth, it discriminated by position on that spectrum. Economist Carmen Reinhart, in her work on sovereign debt crises co-authored with Kenneth Rogoff, This Time is Different, published in 2009, documented that forced currency conversions and deposit freezes have occurred in 66 countries since 1800. Argentina 2001 was not an anomaly. It was a data point in a very long series. This isn't a historical curiosity. This is the playbook. Where are you on the spectrum? The action layer here isn't a portfolio allocation. It's a diagnostic question. Take every significant financial asset you hold and ask one thing. If the institution behind this changed the terms unilaterally tomorrow, the way Argentina did in January 2002, what would you actually own? A 401k holds assets in a structure governed by U.S. tax law and administered by financial institutions. The assets inside it may be real. The wrapper around it is a legal construct that has been modified by Congress multiple times and can be modified again. A bank savings account insured by the FDIC is backstopped by a government guarantee that is itself financed by deficit spending. The FDIC's Deposit Insurance Fund covers roughly 1.3% of insured deposits, according to the FDIC's own 2023 annual report. That's not a conspiracy. That's a published number. None of this means those things are worthless. They're not. It means every financial instrument has a counterparty. And counterparty risk is not theoretical. Argentina 2001 is a 21-year-old case study of what happens when the counterparty reprices the contract in the middle of the night. Knowing where you sit on the spectrum is not paranoia. It's the same